Hello, this is the technical analysis module and this is the candlestick part of it. Candlesticks are very important, widely used for many, an indispensable tool for trading. Our module candlestick is divided in three parts: candlestick basics, secrets of candlestick patterns, and advanced candlestick analysis. In the candlestick basics, we introduce you to the candlestick itself. So basic definitions are provided and some very important remarks are given related to candlesticks. In the second chapter, Secret of Candlestick Patterns, we give you basic tools and approaches to understand candlestick patterns. And we also go through the main candlestick patterns that you should know. Finally, in the advanced candlestick analysis, we give some very specific tools or very specific approaches to candlestick analysis that are, I would say, rarely appear anywhere in the internet or in publications. So some very interesting things that you should know and that will be very helpful for your trading. Now let's start with candlestick basics. The origin of candlesticks. Candlestick originates from Japan, as you probably know. Candlesticks have been used already for centuries in Japan. That might be surprising, but in fact, Japanese rice futures traders have been using candlesticks. One of them, Honma Munehisa, very famous, basically made them a standard. And so candlestick charting and candlestick patterns are today attributed to Honma. Honma by itself is an amazing person, according to the legend. He was actually probably one of the best traders in history, became very rich, very wealthy, and he used candlestick patterns. But it is very important to notice that he didn't only use them. He used also fundamental analysis, and he used tricks of his own. Honma recognized the key importance of the open, the close, the high and low of each trading day. And based on these, he started noticing basically that some specific combinations of these day after day showed that the market had a higher probability to behave in a certain way. These are the candlestick patterns. In the late 20th century, Steve Nissen brought all these Japanese candlesticks to the West. And today they have become a standard tool. So thank you to Steve Nissen and to Honma Munehisa. Let's give some basic definition and some basic examples so that you start understanding what are candlesticks. So let's imagine that we have a market, for instance, a stock market, that works from 9 o'clock till 6 o'clock in the afternoon. And as you can see on the blue line, we have a market behavior. So we started the day at around 121.40. Then we went down. Then we went up somewhere to 123.30, I would say. And then we corrected to something like 122.80. And this is how the day ended. So the chart that is shown now is basically what you would see if you would take a point every, 10 minutes or 5 minutes. This is the chart that you would get. Now, how to summarize the information in the previous chart in such a way that basically you would sum up the main price action that occurs during the day. So let's start by taking the open. Let's start then by searching for the lowest point, the low, as we can see here. Then we will notice also the high, and finally we will notice the close. So these are the 4 points that are key, that summarize the price action that occurred during the trading session. In other words, the open, the low, the high, and the close are basically the main events, the main points of the trading day. This is what Honma noticed and used. And this is what forms the candlestick. As you can see, the candlestick is basically a representation of these 4 points: the low, the open, the close, and the high. And basically, instead of having this complex chart, we can have just a simple candlestick. Now, let's summarize once again. We have the open, we have the low, we have the high, and we have the close. The open is basically the first quoted price at the start of the market. The close is the last quoted price at the end of the market. And the low is the lowest point that was reached during the session, the high being the highest point. Notice that in the example that we gave you before, which was this one, the close was superior to the open. In other words, the price increased during the day. This is called a bullish candlestick because the close is superior to the open. Typically, such candlesticks are colored in green. Sometimes they are colored in white. Now, the opposite, if the price at the close is inferior to the price at the open, then the candlestick is called bearish, and it is typically colored in red or in black. One important remark is that when a candlestick is bearish, the price basically has fallen. When the candlestick is bullish, the price has basically grown. Now, the distance between the close and the open of the candlestick is called the body of the candlestick, as shown on this chart. The lower part of the candlestick is called the leg or the tail, sometimes the shadow. The upper part is called also the shadow of the candlestick. Now, notice something very important. Let's assume that the candlestick that we see is the result of the price action on day 1. So, basically, the close on day 1 is the open on day 2, in this example. Because the market closed, and for instance, the price was a given, let's say $100. When the market opened, the price was again $100. But this does not occur always like this. It happens often, especially in some markets, that after the close there is some aftermarket action, price action. And this causes the price at the open on the following day to be different from the price at the close on the previous day. This is called a gap. Here is an example. So again, the same pattern on day 1, the same candlestick, but then on the next day we have an open which is higher. So this has caused a gap. In this case, we call this a gap up, because the price has moved up from the end of one session to the opening of the other session. And a gap down means that the market has closed lower. Let's have a look at several examples. On the example below, we can see that we have a clear gap down as shown on the picture. The market closed at a price around 0.40, and then at the open the market was below 1.099. This is a gap down. Gaps occur and they are basically discontinuities in candlesticks. As you can see, candlesticks have variable bodies, are red and green, meaning we sometimes lose price, the price sometimes goes down, sometimes goes up. But there are some candlesticks without a body, as you can see that we have pointed with arrows. These candlesticks are specific. They have even a specific name. They are called dojis. It is when the close is open or very close to the open, as seen on these pictures, that we get a doji. Dojis will be discussed in further details in the chapter 2. Now let's watch how candlesticks are formed. Here's an example on how candlesticks behave in real time. As you can see, in this case, bearish candlesticks are in red and bullish candlesticks are in blue. So we see that basically the candlestick changes form during the period while it forms. And then when the period is finished, it gets frozen and then doesn't change after that. So candlesticks will finish, and after that it's frozen. This was a bullish candlestick, and now we'll get the next candlestick. And this one is starting to go down, and it looks like we're gonna have a bearish candlestick. You see, price is going down, and we finish the session bearish. Now, this is a little exercise. Here is a chart of the price action of the GBP, the sterling, against the dollar. Try to find the gap on this chart. It's pretty easy. I just have to look carefully. Now, let's go to the next section. We have several important remarks that we should give you regarding candlesticks. The first remark is that candlestick analysis aims at reading market psychology. It is primarily a price action instrument. You should not rely solely on it. Even Hanma used fundamental analysis, analysis of cycles, and other instruments to complement his decision-making process. This is very important. Second remark, candlestick analysis techniques are much more relevant on daily, weekly, and monthly charts, because the price action that you get on hourly charts, minute charts, are much more noisy, and the patterns that have been built, that have been found by generations of traders, they are not relevant on minute chart and hourly chart. They are mostly relevant on daily and weekly and monthly charts. And this is because there is a lot of trading noise on the lower time frames. Money flows, real money and money flows are much more dominant over market psychology on smaller time frames. Smaller time frames show also discrepancies between brokers. So this gives this is our recommendation. We strongly favor analyzing on daily, weekly, and monthly charts candlesticks. At the edge, we have a 4-hour chart, where we can consider that, but this is really on the edge. And also we have another exception we call candle session. So this is an instrument that we have developed. Candle session basically reflects the following problem. In fact, there are some markets, like the stock market, where a session corresponds to a trading day, and it's basically 8 hours. So you have your candlestick that forms the 8 hours, and you know what happened. However, there are other instruments, such as Forex, commodities, and stock indices, that are traded around the clock. This means that for these instruments, a day corresponds to 24 hours. And during these 24 hours, we have different behaviors during the Asian session, the European session, and the American session. This is why we have created a small indicator that separates that makes basically turns into candles these different parts, and allows you to analyze with candlesticks these different psychology behavior, whether it's European, American, and Asian. This is basically the periods that we use, and this is the geography basically of the Asian, European, and American session. And this is how it looks. So this is a MetaTrader indicator, and there is further information below the video if you are interested. Finally, remark number 3. Candlestick analysis differs between gapping markets and non-gapping markets. You have really two big categories. As I mentioned earlier, the Forex and commodities and stock market indices are traded around the clock. So these are continuous instruments. They have gaps mostly at the exit of the weekend. Sometimes they have gaps also during the trading week, but this is not so common. So these instruments, they don't have gaps, and they have a little bit different patterns compared to, for instance, classical stocks. They are traded on specific exchanges like NYSE, Nasdaq, etc. And they have a big window of time between the close of the market and the open. And there is a lot of price action going on after the close, and also a lot of information. This causes the market for stocks to show much more gaps. And so the analysis of these two categories really differs in terms of candlestick patterns. This is the end of the first chapter of the candlestick module. This is the short introduction. The next block that we'll be discussing is the secrets of candlestick patterns. Candlestick patterns are basically different candlesticks or combinations of candlesticks that tells us something about the market. And in this second chapter, we will show you how to read them in such a way that you'll be able to understand and to find your own candlestick patterns, not rely only on classical candlestick patterns. Also, in this section, we will we will tell you which candlestick patterns you have to know and how to read them correctly. Thank you for your attention.